Hey everyone, and welcome back for another deep dive. This time we are going to be taking a look at misbehaving, the making of behavioral economics. Have you ever made a decision and you knew it was probably the wrong choice, right? And you did it anyway? Well, this book is all about that kind of stuff, so let's get into it.
So behavioral economics really challenges how we've always thought about economics. Like, traditional economics kind of assumes that people are perfectly rational, you know?
Right, like these little robots just calculating the optimal choices, like all the time.
Yeah, exactly. But in reality, people are much more complex. We have emotions and biases that affect our decisions. That's what makes behavioral economics so interesting. It acknowledges that we're not always rational, that we're humans, not econs, as Thaler puts it.
Okay, so we're not these perfect economic machines. He makes that point right at the beginning with this story about Amos Tversky.
Right. So Amos Tversky, he was like this brilliant behavioral scientist, and he was facing a terminal illness.
Oh,
But instead of letting that crush him, he focused all his energy on finishing a book with his colleague Danny Kahneman. It's this really powerful story about dedication to this field. And I think it sets the stage for Thaler's main point. To really understand economics, we need to look at how people actually behave, not just how some theoretical model says they should behave.
so we got to factor in all the quirks and inconsistencies that make us human. I like that he has this list of these behavioral anomalies, these little quirks of human behavior that kind of defy traditional economic logic.
Yeah, he calls it his list. And it's like a collection of all these interesting observations and experiments that highlight the gap between how we should behave according to traditional economics and how we actually behave in the real world.
Like the one where we feel differently about spending money we earn versus money we get as a gift. It's like gift money is somehow less real.
Yeah, that's a great example. It illustrates this concept of mental accounting. It's basically this human tendency to treat money differently depending on where it came from or what we plan to use it for.
Yeah. It's like we have these separate mental accounts for different types of money, and we don't always transfer funds between them logically. Like, I might be super careful about spending money I earn from my job, but I'll splurge on a fancy dinner with money I won in a lottery. It makes no sense economically.
Exactly. And Thaler gives another great example of this irrationality. He talks about this thing called the endowment effect, where we tend to overvalue things we own just because we own them. He tells this story about Professor Rosette and his prized bottle of wine.
Oh, yeah, I remember that story. It's the one where the professor wouldn't sell his bottle of wine for less than $100, but he also wouldn't buy the same bottle for that price either.
Exactly. It perfectly illustrates how once we own something, we place a higher value on it than we would if we didn't own it. It's like we become attached to it, and the thought of losing it becomes more painful than the potential gain from selling it.
It's like our brains have this weird quirk where ownership creates this extra layer of value. But doesn't that kind of contradict traditional economics?
It does. Traditional economic theory assumes that our preferences are stable and consistent, but the endowment effect shows that our preferences can actually shift depending on whether or not we own something. This is a big departure from that perfectly rational econ view. And speaking of challenging traditional economics, Thaler also dives into prospect theory, which was developed by Kahneman and Tversky.
Now, prospect theory, I remember reading about that. It's about how people actually value gains and losses, right? And it's not always this neat and tidy linear relationship.
Right. It basically says that the way we experience gains and losses is not symmetrical. Losing $100 feels much worse than gaining $100 feels good.
Yeah, that makes sense. Losing money always stings more than winning the same amount feels good. It's like the pain of a loss is amplified compared to the pleasure of a gain. But I remember reading that economists didn't immediately embrace prospect theory. Why was that?
Yeah, there was definitely some pushback, especially because it relied on hypothetical questions, like asking people how they would feel in certain scenarios. Some economists argue that these hypothetical scenarios weren't a reliable way to study real-world behavior.
So it was like a battle between the traditional way of doing economics, based on these theoretical models, and this newer, more psychologically informed approach that considered how people actually make decisions in real life. But Thaler argues that we need to incorporate both perspectives, right?
Absolutely. To truly understand economic behavior, we can't just rely on abstract models that assume perfect rationality. We have to acknowledge the role of psychology, emotions, biases, and all those messy human factors that influence our choices.
So it's not just about crunching numbers, it's about understanding the minds behind those numbers. Now, he delves into some pretty fascinating concepts like mental accounting and self-control.
These concepts really resonate because they tap into our everyday experiences. We've all struggled with self-control, haven't we? Knowing we should save more, eat healthier, exercise more, but then those tempting donuts or that new gadget just call to us.
It's like that constant battle between what we know we should do and what we actually do in the moment. Thaler explains this with the idea of the planner and doer selves.
Yeah, so we have these two selves constantly at odds with each other. The planner self is rational, thinking long-term, setting goals. Then there's the doer self, impulsive, focused on immediate gratification.
And it's the doer self that often sabotages our best intentions. It's like that angel and devil on our shoulders, but the devil often has a louder voice when it comes to spending money or indulging in those guilty pleasures. But it's not just about these individual quirks, right? Thaler also talks about how our sense of fairness influences our economic behavior, like how we react to price changes.
Exactly. He argues that our sense of fairness is deeply ingrained and can override our purest self-interest. He uses the example of companies raising prices after a snowstorm.
Oh yeah, that always gets people riled up. It feels exploitative, like they're taking advantage of the situation.
Right. And sailors found that people are outraged by this kind of price gouging, even if they understand the logic of supply and demand. They see it as unfair and are willing to punish businesses that engage in this practice, even if it means paying a higher price elsewhere.
It's like our sense of fairness trumps our desire to get the best deal. We're willing to pay more to avoid supporting a business that we perceive as unethical or greedy.
Hmm.
He also talks about that bank that introduced a $3 teller fee and faced massive backlash.
Right. People were furious. Even though it was a relatively small fee, it tapped into that sense of entitlement. They felt like they were being charged for a service that they had always received for free.
It's like that feeling of, hey, I've always gotten this for free. Why are you suddenly charging me now? It triggers a sense of loss, even though we might not have objectively lost anything.
And that sense of loss is amplified by our aversion to loss, which we discussed earlier with the endowment effect. We're wired to feel the pain of a loss more intensely than the pleasure of an equivalent gain. So even a small fee can feel like a big deal if it's framed as a loss.
So it's not just about the actual amount of money involved, it's about how that transaction is perceived, how it's framed in terms of gains and losses. That makes a lot of sense.
Hmm.
Now, Thaler then takes us into the world of finance, where he challenges the efficient market hypothesis.
Ah, yes, the efficient market hypothesis. This
Yeah.
idea that stock prices always reflect all available information, so it's impossible to consistently beat the market.
Yeah, that always seemed a little too neat and tidy to me. Like, there's no way the market can be that perfectly rational, right?
Well, that's exactly what Thaler set out to challenge. He argues that while the market might be relatively efficient, it's not perfectly efficient. There are these anomalies, these quirks of human behavior that can create opportunities for savvy investors.
So he's not saying the efficient market hypothesis is completely wrong. He's just saying it's not the whole story.
Exactly. He acknowledges that the market is pretty good at incorporating information and that it's hard to consistently predict which way prices will move. But he also points out that there are these behavioral biases that can lead to mispricings, creating those pockets of inefficiency that smart investors can exploit.
He talks about narrow framing, where investors focus on short-term fluctuations rather than the bigger picture. He uses that fascinating example of New York City cab drivers.
Oh, cab drivers.
Yeah.
It's a classic example of how narrow framing can lead to suboptimal decisions. These drivers were so focused on hitting their daily income target that they'd actually work less on busy days when they could potentially earn more.
It's like they were so fixated on that short-term goal that they missed out on the opportunity to maximize their earnings over the long run. It's like that saying, can't see the forest for the trees. They were so focused on each individual tree, each daily fare, that they didn't see the bigger picture, the potential to earn more by working longer hours on those high-demand days.
Exactly. They fell victim to that narrow framing trap. And Thaler argues that investors can do the same thing, getting caught up in the day-to-day noise of the market and losing sight of their long-term investment goals.
So it's a reminder to step back, zoom out, and consider the bigger picture when making investment decisions. Don't get lost in the daily ups and downs. Focus on those long-term trends and fundamentals. He also tackles the equity premium puzzle, right? This mystery of why stocks have historically outperformed bonds by such a large margin.
Right. The equity premium puzzle is a classic challenge to traditional finance theory. If investors were perfectly rational, they'd demand a higher return for holding riskier assets, like stocks. But the historical data shows that the difference in returns between stocks and bonds is much larger than traditional models would predict.
So it's like investors are getting a bigger reward for holding stocks than they should, at least according to theory. But Thaler suggests this might be due to myopic loss aversion, right?
Exactly. Myopic loss aversion is this idea that we tend to overemphasize short-term losses when evaluating investments. We hate losing money, and we feel that pain more intensely than we feel the joy of gaining money. So even though stocks might offer higher returns over the long run, we're scared off by the possibility of those short-term dips and fluctuations.
So we're more sensitive to those losses, even if they're just temporary blips on the radar. But Thaler also brings in Robert Schiller, who kind of throws another wrench into the efficient market hypothesis.
Yeah, so Robert Schiller, he's another economist who challenges this idea of a perfectly rational market. He looked at historical stock market data, like going way back to the 1800s, and he found that stock prices are way more volatile than they should be if they were just based on rational expectations of future dividends.
So it's not just about those fundamental values, those dividends and earnings and all that stuff. There's something else going on.
Right. Schiller argues that these psychological factors, these animal spirits, as Keynes called them, play a big role in driving these market fluctuations. So there's the market has a mood of its own, and that mood can swing between exuberance and pessimism, leading to these booms and busts we see throughout history.
So it's like this collective psychology, this herd mentality almost, that can push prices away from their rational values. It's not always about cold, hard logic.
Exactly. Thaler digs into this idea of noise traders, who aren't necessarily making decisions based on rational analysis. They might be driven by emotions, biases, or even just bad information. Think of it like this. Even if their actions are irrational, they can still have a big impact on market prices, especially in the short term.
Especially if enough of them are acting on those emotions or biases, right?
Yeah.
Like it creates this self-fulfilling prophecy.
Exactly. It's like if everyone starts believing that a certain stock is going to go up, even if there's no real fundamental reason for it, their buying activity can actually push the price up, creating this bubble that eventually bursts.
It's like the market gets caught up in its own hype, creating these distortions that defy logic. He even talks about that crazy case with 3Com and Palm, where the value of the spinoff, Palm, actually exceeded the value of the parent company, 3Com.
Yeah. That was a prime example of how these market inefficiencies can lead to totally absurd valuations. It makes no sense logically, but it highlights the power of investor behavior in shaping these market outcomes. So it's not just about crunching numbers, it's about understanding the psychology of the market. It's about recognizing that human behavior, with all its quirks and irrationalities, plays a big role in driving those market trends.
And one of the ways he explores this is through this fascinating game called the guessing game.
Right, the guessing game. It's this simple game where you have to guess a number, and the closest to two-thirds of the average guess wins. But it gets really interesting when you start thinking about what other people might be thinking.
It's like this recursive loop of trying to anticipate what others will do, knowing that they're also trying to anticipate what you're going to do.
Exactly. A naive player might just pick a random number. But a more sophisticated player starts thinking, okay, what will other people guess? And what will they think that I'm going to guess? It becomes this game of trying to outsmart each other, not by being the smartest, but by being the smartest about how other people are being smart.
It's like you have to get inside the minds of the other players and try to predict their predictions. Now, how does this connect back to the market?
Well, Thaler argues that financial markets are kind of like a giant version of the guessing game. Investors are constantly trying to anticipate the actions of other investors, creating these cascading effects that can drive prices up or down. It's not just about having the best information, it's also about understanding how that information is being perceived and acted upon by others.
So it's this constant interplay between individual behavior and collective market dynamics. It's fascinating. Okay, so we've talked about noise traders, market psychology, these games that reveal how we think about these things. What about value investing? That seems like a pretty straightforward strategy.
Yeah, so value investing. It's this classic approach championed by Benjamin Graham, the father of value investing. It's all about finding these undervalued stocks, these hidden gems that the market has overlooked. Buying them at a discount and then hopefully profiting as the market recognizes their true value. But if the market was truly efficient, you wouldn't expect there to be any undervalued stocks, right? All information would already be reflected in the price.
Right, like if everyone had access to the same information and were acting rationally, there shouldn't be any bargains to be found. But Thaler found that value investing actually does work, right?
Yeah, exactly. He and his colleagues did some research and found that portfolios of these loser stocks, ones that have performed poorly recently, actually tended to outperform portfolios of winner stocks over the long run.
So buying those stocks that everyone else is selling can actually be a profitable strategy.
Yeah. And what's even more interesting is that when they adjusted for risk, using the standard model called the capital asset pricing model, the loser stocks were actually less risky than the winner stocks.
So not only were they delivering higher returns, they were also less volatile. It seems like there's a disconnect there, right?
Right. These findings suggested that psychological factors, like maybe investors overreacting to past performance, could create these market inefficiencies that savvy value investors could exploit. It's like the market gets caught up in these trends, pushing prices away from their true value. And that creates these opportunities for those who can see through the noise and identify those undervalued assets.
It's like being a contrarian, going against the herd mentality and finding those diamonds in the rough. But Thaler doesn't just rely on academic studies, right? He also brings in some personal anecdotes, like his experience with poker.
Oh yeah, the poker analogy. It's a great way to illustrate how skill, psychology, and a bit of luck all come into play in both poker and investing. He talks about how even experienced poker players can fall prey to these behavioral biases.
Like the winner's curse, right? Where you win a few hands early on, get overconfident, and then start making riskier bets, ultimately losing all your winnings.
Exactly. And Thaler argues that the same thing can happen in financial markets. Investors get caught up in the hype, maybe they make a few good trades early on, and they start feeling invincible. But that overconfidence can lead to bad decisions, like overpaying for assets that are already overvalued.
So it's a reminder to stay grounded, to avoid getting swept up in that emotional roller coaster, and to stick to your investment strategy. He was also interested in finding ways to measure these behavioral biases in more real-world high-stakes situations beyond just those hypothetical questions, right? Like, what did he do?
Well, he turned to game shows. Specifically, he was fascinated by Deal or No Deal. You know, that show where contestants pick briefcases with different amounts of money, and then they have to decide whether to take a deal from the bank or keep opening briefcases, risking it all for the chance of winning big. It's like a real-life experiment in risk and decision-making under pressure.
Oh, yeah. That show was intense. It's like you could see those contestants grappling with their emotions, trying to balance the potential for game with the fear of loss.
Exactly. And Feller and his colleagues actually analyzed data from different versions of Deal or No Deal and found that contestants' decisions often deviated from what traditional economic models would predict. Like, they observed evidence of loss aversion, where contestants were more likely to reject deals that felt like losses, even if those deals were actually financially advantageous.
So it's like that emotional pain of feeling like they were losing out on a better deal, even if it wasn't objectively a loss, could override their rational judgment.
Right. It showed that these psychological factors, like loss aversion, can play a powerful role in shaping our decisions, even when there is a lot of money at stake. It provided real-world confirmation that prospect theory, which we talked about earlier, could actually predict behavior in these high-stakes environments.
It's fascinating how these game shows can offer this window into our real-world decision-making processes. Now, speaking of high-stakes games, he also discusses another intriguing game show called Golden Balls, which is basically like a televised version of The Prisoner's Dilemma.
Yeah. Golden Balls was all about trust and cooperation. Each round, two players have to decide whether to split or steal a pot of money.
And the catch is that if they both choose to split, they each get half. But if one chooses steal while the other chooses split, the stealer gets all the money.
Exactly. And if they both choose to steal, they both end up with nothing. It creates this fascinating dilemma because the rational, self-interested strategy is to always choose steal, even though that leads to a worse outcome for both players if they both do that.
It's like a test of whether people will act in their own narrow self-interest or whether they'll trust each other and cooperate for a better outcome. And didn't he mention a contestant named Nick who came up with this crazy strategy?
Oh yeah, Nick. He basically promised his opponent that he would steal, but then he said he would share the winnings afterward. It was a really bold move because he was essentially risking getting nothing if his opponent didn't trust him.
It's like he was trying to hack the system using psychology and trust to overcome the limitations of this purely rational, self-interested approach. And did it work?
Remarkably, it did. His opponent, Ibrahim, trusted him, and they both ended up winning a lot of money. It showed that even in these seemingly cutthroat situations, human connection and cooperation can prevail.
It's a reminder that we're not always driven by pure self-interest. There's this element of fairness, trust, and reciprocity that can influence our decisions. Which brings us to a crucial question. Can we use these insights from behavioral economics to make the world a better place?
Right. Like, can we actually apply this knowledge to improve policies, design better systems, and help people make better choices?
Exactly. And Thaler explores this extensively in his book. Like he talks about automatic enrollment in retirement savings plans, which has been hugely successful in boosting participation rates simply by changing the default option.
Yeah, automatic enrollment is like a classic example of choice architecture. It's basically designing environments in a way that nudges people towards beneficial choices without restricting their freedom.
It's like taking advantage of our inertia, our tendency to stick with the default option to promote better outcomes, like saving for retirement. And he also discusses the Save More Tomorrow plan, right? The one where people commit to increasing their savings rate in the future.
Exactly. It's a clever way to help people overcome their present bias, their tendency to prioritize immediate gratification over long-term goals. By committing to save more in the future, when those future pay raises kick in, it makes it easier to resist the temptation to spend that money now.
It's like outsmarting our own tendency to procrastinate on saving. Now, Thaler also took these ideas beyond academia. He helped establish the Behavioral Insights Team, or the Nudge Unit, within the UK government. They actually applied behavioral science to improve public policy in all sorts of areas.
The BIT, or Nudge Unit, became this really influential group. They tackled issues like tax compliance, energy efficiency, organ donation, all using these insights from behavioral economics to design interventions that encourage people to make better choices.
So instead of relying on those traditional methods, like fines or penalties, they use these more subtle nudges to steer people towards more desirable outcomes, like what they did with those letters to taxpayers who were late on their payments.
Oh yeah, they found that simply tweaking the wording of those letters, like making them more personal or emphasizing the benefits of paying taxes, led to a significant increase in compliance rates.
Just by changing the language. So it wasn't about threatening or punishing people. It was about appealing to their sense of responsibility and civic duty.
Exactly. And those small changes had a big impact. They generated millions of pounds in additional tax revenue. It's amazing what a well-placed nudge can accomplish. And they also experimented with ways to encourage people to reduce their energy consumption.
Like, what kind of nudges did they use for that?
They tried a few different approaches. One involved offering free home energy audits and providing personalized recommendations.
That makes sense. Sometimes people need a little guidance to get started, especially with something as complex as home energy efficiency. Did they see any positive results?
Yeah, they found that offering these audits did lead to some reductions in energy use, but they also found that making it even easier, like by offering free attic cleanups along with insulation installations, led to even greater participation.
It's like removing those psychological barriers, those little excuses we make for not taking action, even when we know it's good for us. But it sounds like these nudges aren't always a guaranteed solution.
Right, they're not some magic bullet. Thaler emphasizes that these interventions need to be carefully designed, tested, and tailored to the specific context. What works in one situation might not work in another.
So it's not just about coming up with a clever idea, it's about really understanding the nuances of human behavior and designing interventions that align with those realities. It's not a one-size-fits-all solution. You got to really think about how people are going to react to these nudges and tailor them to the specific situation. So after all this talk about behavioral economics, like how can we actually apply these ideas to our own lives?
I think the biggest takeaway is to be more aware of our own decision-making.
Mm-hmm.
You know, like pay attention to those moments when our emotions are kind of clouding our judgment or when we're falling back on those biases.
So turning that lens inward and examining our own behavior.
Exactly. Instead of just analyzing other people, look at yourself and how you make decisions. Once we understand our own tendencies, we can start to design our own environments, our own little nudge systems that kind of steer us towards those better choices.
It's like creating our own personal choice architecture to make it easier for our future selves to make those decisions we really want them to make.
Yeah, it's like giving our future selves a little helping hand.
This deep dive has been amazing. I feel like I've learned so much about how our brains work and how these seemingly irrational behaviors can actually be understood and even predicted.
And it's not about beating ourselves up for being irrational. It's about recognizing those biases and then using that knowledge to make more conscious and deliberate choices.
Exactly. We're all human, not those perfectly rational econs. And embracing those imperfections is part of what makes us Well, us.
It's about working with our human nature, not against it.
So as you go about your day, pay attention to those moments when you might be falling prey to one of those cognitive biases. Use those insights to make more informed decisions and navigate the world with a little more wisdom.
And remember, we're all in this together.
That wraps up our deep dive into behavioral economics. We hope you enjoyed it. Thanks for listening.